Most investors fail, not because they're stupid, because they try to beat market, picking individual stocks, timing entries, timing exits. This is hard, extremely hard. Even professionals fail consistently at this. The data is damning. Over 15 years, 92% of active fund managers underperform their benchmark index. These are professionals with research teams, with insider access, with decades of experience, still fail 92%. Individual investors do worse, much worse. Studies show average investor returns 3% annually, while market returns 10%. The gap is massive, 7 percentage points, compounded over decades. This is difference between comfortable retirement and working until death. Why the gap? Trading costs, emotional decisions, poor timing, buying high, selling low, chasing performance. These behaviors destroy returns consistently, predictably, universally. Index fund investing solves this problem. Simple solution: buy entire market, hold forever, never sell. This is boring. This is effective. This beats 92% of professionals. Jack Bogle founded Vanguard, created first index fund, 1976. Revolutionary at the time, now obvious. In hindsight, his insight was profound. You cannot consistently beat the market, so own it, all of it. Index fund owns hundreds or thousands of companies, automatically weighted by market cap. When Apple grows, your fund grows proportionally. When new company enters market, fund includes it automatically. No decisions, no research, no timing. The costs are minimal. Traditional funds charge 1% or more annually. Index funds charge 0.03%, sometimes less. This difference compounds enormously over time. More money stays invested, working for you. 3-fund portfolio is sufficient. Total U.S. stock market, total international, total bond market. 3 funds, complete diversification, global exposure, simple rebalancing. Once yearly, that's it. Nothing more needed, or simpler still. Target date fund, single fund, adjusts automatically as you age. More stocks when young, more bonds when old. Set it, forget it, literally. This works reliably. The key is consistency. Buy regularly, regardless of price. Dollar cost averaging. Automatic investments. Market up, you buy. Market down, you buy. Market sideways, you buy. Remove emotion, remove timing. Just accumulate. Time in market beats timing. The market, always. Missing just 10 best days over 20 years. Cuts returns in half. You cannot predict those days. So stay invested, always, fully. Market crashes will happen, guaranteed. 20% drops every few years, 50% drops every decade, maybe. This is normal, this is expected, this is opportunity to buy. Cheaper shares, not reason. To sell, your behavior determines outcome more than market performance. Stay the course. During crashes, this is when fortunes are made or lost. Discipline matters more than intelligence, more than luck, more than timing. Dividends reinvested automatically. This is crucial. Dividends are a significant portion of total returns. Historically, 40% or more. Reinvesting them compounds faster, much faster than taking cash. Tax efficiency matters too. Index funds rarely distribute capital gains because rarely trade. This means lower taxes, more money, compounding in your account, not going to government. Start early, even small amounts. 25-year-old investing 200 monthly becomes 700,000 by 65 at 10%. Return, 45-year-old, same contribution becomes 150,000. Time is multiplier. Start now. Increase contributions over time. Get raise? Increase investment. 10% of raise goes to future. You never notice, never miss, but compounds dramatically. Over career, ignore financial media, ignore predictions, ignore fear-mongering. They need your attention, not your success. Turn off CNBC, stop reading financial headlines. Check portfolio once yearly at most. This protects from emotional decisions. This strategy is not sexy, not exciting, not something to brag about at parties, but it works better than almost anything else. For average investor, which is all of us, Warren Buffett agrees his will instructs executor put 90% in S&P 500 index fund, 10% in bonds. For his wife, if world's greatest investor recommends this for his family, maybe we should listen. Index fund investing is not get rich quick. It's get rich slowly, reliably, predictably, over decades. This is path to wealth for most people. Accept it, embrace it, execute it, retire wealthy.